Rocks. Thank you, Melissa. I'm doing my best here to keep up. With that being said, we're about 10 minutes in. We're going to go ahead and get started and talk about taking the leap to get to multifamily investing. Um, the bullet points that we're going to cover today, the different types of multifamily investments, understanding your specific goals. And these are individual personal goals that everyone needs to set, and how you match that with an investment type. And then how to get started with your first multifamily investment, and then the level of effort required based on asset types. So let's get started with the first item in terms of the different types of multifamily investments? Well, the way multifamily industry really works is you talk about the types of properties based on their age, based on their location, and based on their build structure. So, from a build structure perspective, you have garden style apartments, which are pretty much the most common type of apartments that are out there today. These are in your residential communities. They're maybe 2 to 3 stories high, with a collection of, somewhere between 4 to 20 apartments in one kind of building or dwelling. And the garden style apartments, it's usually spacious with some green areas like grass or playgrounds. That's typically the most common type of build construction, garden style. It's a lot of what we invest in. You have mid rise, which is a more condensed building type. And typically you have maybe one physical building, and all of your units are in that building, and it has potentially an elevator or not. It is usually built in a more congested, a higher, I'm trying to think of the right word here and I'm just blanking on it. But it's typically built in a more downtown type of community where there's higher population and less available land space. So you typically have more units built on fewer acres of land. And then you have your high rise, the type buildings, which you would see in like a Manhattan or a Miami or a San Francisco, where you have a very small footprint of land used, but you build it way up. So garden style, mid rise, and high rise type of apartments. So those are the different building and construction types. And then you typically talk about the different types based on their vintage. So if a property is built in a certain decade, like a 1960s or older, 1970s or older, 80s, 90s, 2000 and newer, 2010 and newer. Those are the types of properties. Usually, when you're talking about something that's built within the last 10 years, it's typically the rule of thumb. Typically, you would call that like a class A property, because it's newer. It doesn't need as much repairs. It's just a little bit nicer. So, kind of class A. Class B would be that 2000, maybe 1995 to 2010, where it's 10 to 15 years age, maybe 20 years old. It could be in need of some upgrades and some repairs. So those are the different types of investments. And then based on what the business plan is, you may talk about a property being a heavy value add. It may be just a light value add, or it may just be a cash flowing asset. And it's typically based on how old it is. So the older a property is, the more repairs that are typically required, or the more upgrades that you need to put into the property to have a product that folks want to live in, keep your residents happy and have it be new and fresh, and really trying to achieve market rents for that particular neighborhood. So, with that, how do you understand what your goal is and really matching the investment type? This piece is extremely important if you find yourself struggling to find an investment opportunity, or you may be saying, well, I look at so much stuff, nothing ever works. And I think it's probably because your goal is not specific enough for you to hone in your criteria of exactly what you're looking for. And so, you know, I always find the goal that each person needs to be extremely specific to your scenario. So let's say you are new to multifamily and you work a full-time W-2 job, and your goal is to replace your W-2 income with monthly cash flow from a multifamily asset. Well, your goal is now very specific. And I would say get even more specific with how much money you would need to earn to replace that W-2, excuse excuse me, paycheck on a monthly basis. So easy math here for me this morning. If you make 120 grand a year from your W-2 job, you need to earn $10,000 a month in to replace that W-2 paycheck. I'm not going to take into account taxes or anything like that, payroll burden, things of that nature. We're just going to keep it simple this morning. So, $10,000 a month. Well, what type of multifamily asset in the markets that you're looking at generate $10,000 a month? I'm guessing it's not a 4 unit. I'm guessing it's probably not a 10 unit, but maybe you need to be looking at a 100 unit property in order to cash flow $10,000 a month. Or, maybe you need to look at a 150 unit property in order for your ownership percentage to cash flow, because you may be partnering with someone. And so think about your specific goal. Let's say on the opposite end of the spectrum, let's say you love your job, you love what you do, you're never going to quit being a physician or maybe a small business owner, and you just want to invest in multifamily for a place to um, get tax advantages, maybe make a little bit of money month over month along the way, but you're really in it for long term value and growth. Your investment type may be different from that. So, in the case of um, in the case of the W-2 person who wants to quit their job, maybe they can go after more of a value add or heavier value add opportunity because they want to put in more sweat equity and increase rents and get a better purchase price or a better deal, potentially, and have more cash flow for them, versus the person who wants to continue working and really is looking for that long-term investment, from a security perspective, from a growth perspective. Maybe they're going to look for a newer built property where there's less maintenance, there's less day-to-day oversight required, and it's more of a kind of buy it, let it cash flow, let it continue to kind of work itself, and you're really in it for the long term. And so, really think about what your personal goal is. Everyone is going to have a different goal, and that's okay. But when there's a different goal, there's a different investment vehicle that fits your specific goal. And so, just because our group buys properties that are 200 150 units or greater, that's 25 million to 70 million dollars, doesn't mean you have to buy the exact same property types. um, Figure out what your goal is and figure out what investment type you need to look at to go after it. um, Moving on, I'm going to pause for just a second. I saw a couple of questions, maybe not. Q&A box. No. I believe someone raised their hand. If you have a question, feel free to put it into the chat box, and I'd be happy to address questions along the way. Um, Moving on, let's see here. Susan, did you have a question? Go ahead and put it in the Q&A or the chat box. Let's see here. Uh, for those of you, Melissa, if you could work with Kari in the Q&A box, I would appreciate that. I'm going to let you handle that question privately, and we will go from there. How to get started with your first multifamily investment. Well, now that you've established your goal and you know what property type, what investment type you need to acquire to meet your goal, you can get started with looking for those types. So the best way to get started is through building relationships with brokers, property managers, maybe other owners. Get involved in a local real estate investor meeting, either through Meetup, network with the Multifamily Investor Nation meetups that are out there. I think we're in 52 different cities. So if there's not a meetup in your city, get started with one. Melissa can help. Reach out to us through the MFIN group, and we can get you set up that way. Having a meeting to go to and network with other folks in the industry is one of the best ways to get started and find opportunities. And so when you're first getting started, the most important part to it is to have a goal of closing on a property by a certain time, and getting a deal done and learning along the way is one of the most beneficial pieces to your success. And so even if you're the W-2 employee today, you want to quit your job, you want to replace your income, maybe starting, if your goal is to get $10,000 a month, getting started with one property that generates $1,000 a month is a great way to do it. If you're thinking having one property that generates 10,000 a month is going to be too big to start, that's okay. But the most important piece is get started, start learning, start networking with people, and you're going to be much better off by doing a deal, getting one done, because in order to do 3 or 4 or 5 deals, you need to do the first one and then you can do the second one. And so kind of just get started, get comfortable, have a network of people that can help you along the way as well, which is very, very important. The Multifamily Investor Nation group is here to help. There's so much content available. Don't get bogged down in analysis paralysis. Really, you need to take action, set your goal, and actively pursue activities that are going to get you achieving that goal. What level of effort is required based on asset type? Well, things vary. If you have a heavy value add deal, maybe it was built in 1960, it's going to require a lot more time and effort to oversee it, to improve it, to maintain it, versus a property that was just built in 2018. There's going to be less repair and maintenance. There's going to be less things breaking or needing attention when the product is much newer. And so you need to think about that with what your goal is. What is your day-to-day life? And that's, again, really, really important as you think about what investment type fits your specific need. So don't go after investment types just because it's a good deal. Go after what investment type fits your personal goal. And The level of effort is a big thing. So if you are a person who maybe your goal is to retire early and have cash flow coming in from multifamily without the headaches, without the hassle, um, maybe you're not the type of person who needs to be an active owner, but maybe you're more of a passive investor in multifamily deals. And rather than um, spending the time to build the team, to find the deals, to oversee the business plan, to follow up on items. Maybe your goal is to really just have passive income where you have the freedom of your time. You can spend time with your family. You can spend time doing what you enjoy doing. Maybe that's, keeping your job as it is, or, just spending time in your community. However, you want to do that, again, it's really important to understand what your goal is, what investment type fits that goal, and then figuring out the level of effort that you need to put in along the way. And so, with that, I am going to kind of wrap things up here from my side. I'm going to check the Q&A box. I'm going to check the chat box. So be sure to ask your questions. I am here to help address your specific needs, and we'll just keep going along the way. So let me see what we have here. Um, Question: how are 2 to 4 unit multifamily properties appraised, and are down payments higher typically? Susan, 2 to 4 unit multifamilies are typically appraised based on comparable sales approach. You may also have an appraiser who does it based on the income approach. I would guess because it's technically a residential property up to 4 units, because you can get a residential loan on it. They will appraise it both ways. They'll do an income approach, but they'll also do a comparable sale approach. So if the 4 unit next door sold for 400,000 and you have a very similar like kind 4 unit right next door, yours is probably worth 400,000, even if you have rents that are twice as high because you have a bunch of corporate leases in there. They're going to kind of price them the same way. Down payment is variable based on your lender. So I would talk to several local community banks or credit unions in your area to figure out what sorts or what types of loan programs they have based on down payments and things like that. I am just reading through. Okay, Susan, you had another question. By passive investor, do I mean acting as a lender? No, what I mean is acting as an investor in a multifamily syndicator's opportunity. So, we as passiveinvesting.com have investment opportunities that we share with our network of investors. And when those opportunities come up, you raise your hand as a passive investor and you would invest in another operator's deal, because we do the active day-to-day work for that property. You don't have to do that work. So that's what I mean by a passive investor. And if you go to passiveinvesting.com, we have some frequently asked questions section and definitions. You can get a better idea of what I mean by those. A securing financing question in here. How does one get funding for a large property, 1.5 million and up? Well, you talk to several. I would talk to, if your purchase price or your loan amount is above $1 million, I would talk to a few um, national lenders or brokers and ask around. Even some of the larger banks like a Wells Fargo or a Chase will have some sort of program for you. You know, if you're involved in a network as well with local real estate investors, people there would probably have a great idea of who is good to work with in the area from maybe a local bank or community bank perspective if you wanted to do that. Um, that is there. Let me see here. Securing financing. We talked about that one when I invested in a single family home. The question in here was ROI on a single family versus ROI on a multifamily. It really depends on the area, the type of property. One of the risks you have with a single family home, even if the ROI is really, really good, what happens if your tenant has complications either financially or medically with COVID and they can't pay rent? Having 100 units, you have the power of scalability to get better anticipation of the business plan. And so, not everyone who lives in the unit could be affected by COVID, could be affected with a job change. But if you just have one property, one tenant, you may have a challenge there. The other piece, um, ROI may be different on a pro forma basis depending on your expenses. So, it's really, really hard to compare single family ROI to multifamily ROI. But I would just say keep looking for deals. I think they're out there. Um, where can you find off market family or off market multifamily deals? Talk to your network, reach out to property managers, reach out to brokers, contact sellers directly. I talked about financing a little bit. If you have another question, feel free to put it into the chat box or the Q&A box. We're going to wrap up here in a couple of minutes. I don't see many more in here. Let's see here. Due to COVID, possible effect on investment, do you think it would be better to own 10 to 12 single families as rentals or equivalent doors comprised of 2 to 4 unit buildings? Crystal ball reading of the likelihood of hurting the owner because of rent payment relief and eviction. Well, from John, from a unit perspective, whether you own 20 single family houses or one 20 unit apartment building, I think your risk of COVID impacts, if they're in the same market, would be fairly equal because, again, what you're basically trying to do is scale up to have um, a, a higher denominator of residents versus a numerator of residents affected by challenges. So if you only have one property, one unit, if that one person has a challenge, then your income goes from 100% to 0%. And so having 20 residents, maybe one or two are affected and you are still able to operate your business entirely or in totality when you count all of your units. So the reason you would prefer most likely having one 20-unit property is because all of the units are on the same physical property. Ideally, units are sharing some of the same roof system, some of the same plumbing and electrical, the same driveway, the same landscaping. And so you're better able to control your expenses and really um, operate the business in an efficient um, and predictable and scalable manner, as opposed to 20 different single family properties, 20 different roofs, 20 different driveways, 20 different landscaping expenses, and things like that. Please explain what pro forma is. Susan, pro forma is a future expectation of your operations. So if if you have a 20-unit property and you buy it today, your year one pro forma would be how you expect to operate the property. So how much income do you expect to collect over the next 12 months? And what do you expect to spend on expenses over the next 12 months? And what's your debt service, and what does your returns look like as you're projecting them out in your pro forma? So pro forma is really important. It's basically like your business plan, is another way to think about it. If you live in one of the units and manage the property, would that make a difference in the financing? Beverly, living in one of the units would only make a difference if you're buying a 4-unit or less property, because if you live in one of the 4 units, then you can get a primary residential loan for it. So yes, anything greater than 4 units, no, it would be a commercial loan. It would not be a primary residence loan. Thinking in terms of large scale owners, therefore, thank you for, oh, perfect, John. I'm glad I got your question answered. Let's see here. Anything else in the chat box? I think we got everything addressed. We answered everyone's questions. If there's a last minute question, feel free to put it into the Q&A box or the chat box. But again, thank you everyone for being here. Brandon will be with everyone next week, Tuesday. He will have his topic to share with you. And we look forward to seeing you at the next webinar, but also at the upcoming Multifamily Investor Nation virtual summit, January 21st through the 23rd. So that'll be a great place to go. And thank you everyone for being here this morning. Have a great rest of your day. And join us next week. Brandon will be speaking and sharing his topic.